Now you asked for it, more regular crude oil analysis, and hopefully I'm bringing that to you through a new weekly report. And that report, just doesn't contain the chart analysis that I normally do in the chart of the day video, but on top of that I'm throwing in commitment of trader analysis, seasonality, rig count, supply and demand, inventory, and much more. So with all that new information for you, let's get on with the analysis. Hello, I'm Stephen Hode, trader and founder of the Stop Hunter. So before we can carry on, a risk warning for you to pay close attention to. The content in this video is not investment advice, so please seek the advice, help of financial professionals or financial advisors before investing and trading. And trading and investing involves a high degree of risk and your money is at risk, so be very careful. So with that out the way, let's get on with the analysis. So jumping straight into some of the new analysis. Now what have we got here? We've got a daily crude oil chart. It's the NYMEX pricing and it's the front month futures contract rolling over through time. So called a generic price there. And on this chart we have commitment of traders analysis and some seasonality information. Two important fundamental sort of sentiment indicators that can help you in your oil trading. Now over the course that I produce this video series, then I'm going to keep this format pretty much the same so we can see consistent changes in the results. Now if we head to the bottom of the chart, we've got that grey line area. That's actually the seasonality of the market. Now the grey line is a 1 year seasonality, and then the two lines, the moving averages there, the blue and the purple line, are sort of averages over a longer term period, many years looking back, to give us an idea whether the price is moving in terms of how it works fundamentally over the year. And oil is quite a seasonal product, and you can use it as a good guide. It's obvious why it does what it does. And at the moment we are in a sort of declining part of the seasonality. We've had the run up from May and the price, and we've seen that historically as well, and we then have to jump right over to the left to see what's going to happen next. And it still seems to be some upside going on there until about October, when the seasonal price comes off down into the sort of mid part of November before starting to pick up again. So that's the seasonality. Now if we jump above that to the next two lines, you see a red line. That is the commercials in the COT, commitment of trader analysis, and what we're looking for here is sort of an inverse relationship to the price to give us a clue where price is heading next. So if the commercials are up, we'd expect to see the price down and vice versa. Now the black line is a COT index of the large speculators, and normally it's their job to make money and stay in their job by making money, so we expect that line to go more in sync with the actual direction of the price. And I have some bands around that where I think things are trying to maybe get a bit overheated, and that's at 90 and excuse me 10. And at the moment we can see that on the large speculators we've had a fall in the values there to the under 10 area, and we can go and draw that comparison to the price and we can see that correlation. And we can also see from the red line, as that has increased, the commercials, the price also coming off. So at the moment the COT, the commitment of data information, is giving us a bearish viewpoint at the moment. And it's got to be remembered, the commitment of traders information is more of a longer term tool. It's updated every Friday, so you've got to expect movement of price in between, but as a longer term gauge it can be useful, as is the seasonality. And we are going to be running this, like I say, weekly in this analysis to give you a maybe a bigger perspective, a different perspective from just straight price analysis that you could maybe add into your strategy. So the takeaway at the moment from seasonality is it's running out of its bullishness maybe, and the commitment of traders bearish at the moment. So now let's go on and look at two other aspects around fundamental information. That's rig counts and inventories. Now, Baker Hughes are the leaders for providing rig count information. I use their website to get this information. It can be downloaded elsewhere, so you can build up a history of how things have been developed. But essentially, it's an important business barometer for the drilling industry and its suppliers. So when we see more active rig counts and they're up, they're consuming products and services produced by the oil service industry. So it's quite a bullish sort of barometer to look at, or bearish on the flip side. So you could call it a leading indicator of demand for products in that industry, and we can use that and factor that into our price analysis. So if we look at the moment, I really focus on the US because that's, I think, the most important one of the three. It's got US, Canadian and international, and we can see that rig counts are slightly up and there's more of a change, 249 from last year. So to you guys at the moment that might be pretty meaningless, but over time we'll track that number. I'll try and graph it for you and we can see how that is impacting on the price. And remember, we're going to use this as a possible leading indicator to support our technical analysis. So I'm on a website called investing.com. It's completely free to use, and that's why I'm throwing it in here, because it's accessible to all for the information that we want. Now, another good gauge of supply and demand are crude oil inventories, and every Wednesday around 3:30 UK time the EIA release that information, and that can give us a picture of, like I say, the fundamental side of oil that we could maybe tie into a technical analysis strategy. Now there's three bits of information that we need from here. We look at the previous amount, and then we can see at the top there was minus 0.447 million, a forecast amount which is minus 1.055 million, and an actual amount. And it's that difference in that actual amount when it's published versus the forecast that we're looking for to gauge a better idea of where we think the price might be going. And it's nicely put there on the investing.com website what that means. It says there, if the increase in crude oil inventories is more than expected, it's weaker for demand and therefore bearish, and vice versa to the other side where it becomes more bullish. Now, and if we scroll down inside there, we can see historical chart of what's happened to the inventories over time, and we can scroll down, we can actually see the upcoming event on the 25th at 3:30. The previous number plotted in there from minus 3.234 million barrels. Forecast is minus 2.367, and that area is left blank to be filled in. Now, I've looked into trading the news, that actual event, and it's more 50-50, and I like to now use that as a longer term sentiment gauge that I marry into technical analysis strategy, rather than trying to really coin toss that actual versus forecast outcome. So with that, let's now get more directly into the technical analysis and see the sort of stuff that you've been used to through the chart of the day video. So on the weekly line chart, what can we take away from that? Well, we've got a lot of history there going back 4 or 5 years, And price currently sitting in the mid $60, just above the 78.6% Fibonacci line. There has been sort of support around that $63 area in the past, in 2019 and 20. Breakdown from there, and we're looking at 53, and then 46, and then down to that key 39, 38.2%. But that's a big shift in the price, and to the upside, it's got to really retest those mid 70s, $75, $76 highs before breaking on upwards. And the Fibonacci extension there, looking around $90 if it can go higher than that 75 previous highs. So with that, let's move on to the daily Heikin Ashi view. Don't forget that I'm using the NYMEX CME front month light crude future WTI contract here for the price feed into the charts. Now going down to the bottom, our indicators, well, they have been bearish but look like they're starting to turn up, so we might have seen the bottom of that recent sell-off from sort of mid-July. We have various short sell signals. If we go straight into the price action at the top there, outside of the box setup, volatility has picked up a little bit but nothing unusual. That's the middle red line on its own, and volume actually overall seems to be dropping a little bit. It's bearish but it's falling, and currently we've got a bullish Heikin Ashi bar around, like I say, that 60, early 60 area where there has been a lot of support noise in the March, April time. So overall it has been weak bearish but maybe stabilizing for a more neutral feel at the moment. So on the Renko chart, I've used a block size of 50 cents, which is quite aggressive, and that's to give me more action. And the signals below both starting to turn a bit more positive, and you can see the Renko blocks starting to turn north again around that 60-61 support area. Now I've drawn two Fibonacci trend line bits of analysis onto the chart. One a longer term one, which goes back to those lows about a year ago and up to the highs of July time around those mid 70s, and the other one's that short term downtrend, and that's then given me a grid of key Fibonacci numbers, dollars, that I can use as support and resistance, stop losses, targets, that sort of thing. Now if we focus in on that, we can see the price bouncing at, like I said, that 61, 62 area to the upside. It looks like in the short term high 60s before hitting some maybe resistance, and then it's got to push on up to those highs 76, $75, $76, and then if it can break there, a bit like the weekly chart, you've got a predicted Fibonacci high around $88, $90. So quite a good looking upside there if things can turn more bullish. Now to counter that to the downside, if it doesn't continue this short term reverse in price on the Renko chart and continues that short term downtrend and breaks that 61.60 area, then to the downside you got the mid 50s, then you're around about the 50 area, and then down probably into the mid 40s in the medium sort of term. So I've also put on the 2 standard deviation regression lines. That's that sort of salmony pink color and blue, just to show how the price action has developed within that range, and it's quite likes holding that mean middle line there in that trend, and once it hits the boundaries of the 2 standard deviations it has been reversing from there, and that's what we're sort of seeing at the moment. So takeaways from the Renko chart, maybe looking a bit more bullish in the shorter term, The medium to long term maybe a bit more undecided, maybe a bit more neutral, but generally we could take away a weak bullish sort of conclusion to the Renko chart at the moment. So let's put all of that analysis, all of the new stuff, the seasonality, the rig counts, all of that, throw it all into a summary to see where we're at with crude oil at the moment. So let's summarize things then. So in terms of signals, it's a tricky one with the crude oil. It's got the feeling of being weak bullish overall. Interested in the support area that it's sort of focusing on that current bounce. Fundamentals are a bit mixed, as you can see in the top right box. I've added that other section that summarizes seasonality, COT, rig count, inventories. I've just got a feeling it's favouring the bullish side at the moment. The Renko was more bullish in the shorter term compared to the Heikin Ashi, that I would say is probably more neutral overall, even with a slight bearish tinge to it. But if we're focusing on the signals, yeah, it looks like the downside has more risk return available to it than the upside. But like I say, it's just got that feeling overall of looking to bounce, from this, pullback that we've seen. So really it's a case of keeping an eye on the signals and sticking to your strategies, especially in the technical analysis world. If you get those signals, follow them, stick to that plan. But overall, crude oil, I'm going to give it a weak bullish overall opinion. I hope you've enjoyed this new weekly report I'm going to produce on WTI crude oil. If you have, and you've enjoyed the video, please give us the thumbs up. Don't forget to hit the subscribe and bell buttons to receive future notifications of when I'm going to put this report out. Hopefully it's going to be out in the early part of each week, but there's a lot more other content that I produce that you might find interesting, so please subscribe and help the channel out. And also, I love your feedback. Please put in the comments below where you think crude oil is going next. Do you agree, disagree the analysis? Love to get the chat going down in the comments. And if you've liked today's technical analysis and the other information I've provided, I'm going to put some links in the description below for you to follow if you'd like to learn more. Now all that's left for me to say is thanks for watching, good luck with the trading, and I'll see you in the next video.